Hey everyone, and welcome back to the channel. Today we're diving into a topic that affects almost all of us. Taxes. I know, not the most glamorous subject. But what if I told you that with a little bit of planning, you could legally reduce the amount you owe? That's right, we're talking about tax planning, the smart and completely legal way to keep more of your hard-earned money in your pocket. This isn't about finding shady loopholes or doing anything sketchy. It's about understanding the rules of the game and using them to your advantage. So, grab a coffee, get comfortable, and let's explore some powerful strategies to minimize your tax burden. First things first, what exactly is tax planning? Think of it like this. You wouldn't build a house without a blueprint, right? Tax planning is the blueprint for your financial year. It's the process of arranging your financial affairs in a way that legally minimizes your tax liability. It's a proactive approach, not a reactive one. Many people wait until tax season, panic, and try to find deductions. But the real savings happen when you plan ahead throughout the entire year by making strategic decisions about your income, investments, and expenses. You can significantly lower your tax bill. It's all about being intentional with your money. So, where do we start? The absolute foundation of good tax planning is maximizing your retirement contributions. This is one of the most powerful tools available to the average person. When you contribute to a traditional 401k or a traditional IRA, that money is often tax deductible. This means you don't pay income tax on it in the current year. Let's say you re in the 22% tax bracket and you contribute $5,000 to your traditional IRA. You could potentially save $1,100 on your taxes right away. Plus, that money grows tax deferred, meaning you don't pay taxes on the investment gains each year. You only pay taxes when you withdraw it in retirement. It's a double win. You're saving for your future while also saving on taxes today. Next up, let's talk about health savings accounts, or HSAs. If you have a high-deductible health plan, an HSA is an absolute powerhouse for tax savings. It's what we call a triple tax-advantaged account. What does that mean? First, your contributions are tax-deductible, just like a traditional IRA. Second, the money in the account can be invested and grows completely tax-free. And third, when you withdraw the money for qualified medical expenses, those withdrawals are also tax-free. There's no other account like it. You can use it for doctor visits, dental work, prescriptions, and even things like glasses and contacts. And the best part, after age 65, you can withdraw the money for any reason, and it's just taxed like a traditional IRA. It essentially becomes a supplementary retirement account. If you're eligible for an HSA, you should seriously consider maximizing it. Now, let's move on to something called tax loss harvesting. This sounds complicated, but the concept is pretty simple. It applies to your investments in a regular taxable brokerage account. Let's say you have an investment that has lost value. You can sell that investment at a loss and use that loss to offset any capital gains you might have from selling other investments that went up in value. For example, if you realized a $10,000 gain from selling one stock, but you have another investment with an $8,000 loss, you can sell the losing one. Now, you only have to pay taxes on the net gain of $2,000. And what if your losses are greater than your gains? You can use up to $3,000 of that excess loss to offset your regular income, which is a huge benefit. Just be aware of the wash sale rule, which prevents you from selling a security at a loss and buying it back within 30 days. This strategy requires some careful timing, but it can be a very effective way to manage your investment taxes. Are you a homeowner? If so, you have some great tax planning opportunities. The interest you pay on your mortgage is often tax deductible, up to a certain limit. This is one of the biggest tax breaks available. Property taxes you pay on your home are also deductible, though there's a cap on the total state and local tax deduction, which includes property, income, and sales taxes. Also, if you make energy-efficient improvements to your home, like installing solar panels or new energy-efficient windows, you might be eligible for tax credits. A tax credit is even better than a deduction because it reduces your tax bill dollar for dollar. For example, a $1,000 credit saves you $1,000 in taxes, period. A $1,000 deduction only saves you a percentage of that based on your tax bracket. So keep your receipts for any home improvements. For those of you who are self-employed, run a side hustle, or work as a freelancer, you're in a unique position. You're basically running a business, and that comes with a whole host of potential deductions. You can deduct ordinary and necessary business expenses. This includes things like home office expenses, a portion of your internet, and phone bills, office supplies, software subscriptions, business-related travel, and even health insurance premiums. The key is meticulous record keeping. You need to track every single business-related expense. Use an app, a spreadsheet, whatever works for you, but keep detailed records. Also, remember that as a self-employed individual, you're responsible for paying your own self-employment taxes, which cover Social Security and Medicare. Let's also consider the power of charitable giving. If you itemize your deductions, you can deduct contributions you make to qualified charities. This can be cash, but it doesn't have to be. You can also donate stocks or other appreciated assets. This is a particularly savvy strategy. Let's say you have a stock that you bought for $2,000 and it's now worth $10,000. If you sell it, you'll owe capital gains tax on that $8,000 profit. But if you donate the stock directly to a charity, you generally get to deduct the full $10,000 fair market value, and neither you nor the charity has to pay capital gains tax. It's a wonderful way to support a cause you care about while also receiving a significant tax benefit. Again, make sure you get a receipt and that the organization is a qualified charity. Another important concept is understanding the difference between tax credits and tax deductions. We touched on this earlier, but it's worth repeating. A deduction lowers your taxable income. A credit directly reduces the amount of tax you owe. There are many credits you might be eligible for, like the child tax credit if you have kids. Education credit like the American Opportunity Credit if you're paying for college, or the Earned Income Tax Credit for lower-income workers. Always check to see which credit you might qualify for, as they can make a huge difference to your bottom line. Don't leave this money on the table. Finally, while all these strategies are great, the most important piece of advice is this. Consider consulting with a professional. A qualified tax advisor or a certified public accountant. A CPA can look at your specific financial situation and help you create a personalized tax plan. The tax code is incredibly complex and it changes frequently. A professional can help you navigate it, ensure you're in compliance with all the laws, and identify opportunities you might have missed. The fee you pay them can often be saved many times over in tax savings. It's an investment in your financial well-being. So, to recap, max out your retirement accounts like your 401k and IRA. Use an HSA if you're eligible. Strategically harvest tax losses in your investment portfolio. Take advantage of homeowner deductions. If you're self-employed, track all your business expenses. Be smart about your charitable giving, and always look for tax credits you might qualify for. Tax planning isn't a one-time event. It's an ongoing process. By being proactive and informed, you can take control of your financial destiny and legally keep more of your money working for you. I hope you found this information helpful. It can seem overwhelming at first, but just start with 1 or 2 strategies that apply to you and build from there. If you have any questions, please drop them in the comments below. And if you enjoyed this video and want to learn more about personal finance and building wealth, make sure to hit that like button and subscribe to the channel. Thanks so much for watching, and I'll see you in the next video.